You've worked and saved diligently to retire comfortably on your terms. Now the challenge is to protect your hard-earned wealth while ensuring your portfolio will provide for you in the decades to come. The conventional wisdom for constructing your retirement portfolio is to have the percentage of bonds and cash match your age. So a 60-year-old would have 60% in bonds and cash and 40% in stocks.
Unfortunately, we feel it's no longer this simple, because in today's investment environment, an asset allocation with significant bonds and cash will be exposed to interest rate and inflation risks. Here's what we mean by that. As savvy investors know, interest rates and bond prices have an inverse relationship. So when interest rates rise, most traditional bonds lose value. Due to historically low interest rates, we think the estimated return on bonds over the next several years is dim. One popular way to forecast the expected gains on bonds is to assume their return will equal their current yield. With the yield on the 10-year Treasury note around 2% currently, we urge investors to temper their expectations for returns going forward. When inflation is subtracted out of these returns, bonds could potentially fail to deliver any real gains in purchasing power. So we can throw that conventional wisdom out the window.
Another threatening trend is on the rise of healthcare costs. Maintaining your purchasing power is crucial, as spending on healthcare will likely consume a larger portion of your budget in retirement. Even more concerning than the high inflation rate are unexpected costs such as long-term care, which is not covered by Medicare. A recent Genworth study found that the average cost of a private room in a nursing facility is $92,000 per year, a figure that has grown by 3.5% annually in recent years.
The paradox for retirees is that they must continue to grow their portfolio even as they begin spending from it. In our next video, we'll offer up one way to handle this balancing act.